Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Gold and silver plunge as political and economic worries ease, but expect volatility to continue. This article was written by Daniel Jones. Summary. Pause. Gold and silver experienced extreme volatility, with gold down 8.3% and silver plunging 25.5% in a single day. Current elevated prices for gold and silver are driven by governance risk and political uncertainty, not traditional inflation hedging. Investment demand for gold surged 73.3% year over year, while end-use demand, jewelry, technology, declined as prices soared. I maintain a neutral stance. Gold and silver serve as hedges for political instability, but upside is limited absent new escalations. My name is Dan Jones. I have degrees in accounting and economics, and ran a registered investment advisor for 9 years. I lead the investing group Crude Value Insights. January 30th was a fascinating day for market participants. Gold prices closed down 8.3% for the day. But even worse, far worse in fact, was silver. Those prices plunged 25.5%. Precious metals typically don't experience this kind of volatility, especially on the downside. Spikes in response to geopolitical issues can be common, but big drops like this are rare. For the last year or so now, prices have been moving up, likely driven by multiple factors. And now, as certain near-term risks are subsiding, there is a move away from these metals and toward productive assets. If you follow my work closely, you will almost certainly know that I am not exactly the biggest fan of gold. In my last article covering it, published in early September of last year, I acknowledged that prices could soar in the short run. But I also warned that the move higher would not last. Sure enough, prices are currently up 35.1% since then. The S&P 500, meanwhile, is up only 6.8%. I don't really follow silver all that closely, but it has also skyrocketed in recent months. Long term, I believe that these metals are really just a hedge against inflation and potential economic decline. But since I am generally positive on the global economy, I view productive assets as being far more attractive. The market demonstrated on January 30th just how an irrational rise in prices can unwind. I do think it is necessary, however, to say that when my article was published, I did not anticipate some of the extreme events that have occurred since then. 2 catalysts were known at that time that all but guaranteed that prices would remain elevated. But we have had a couple of other ones come out since then, entirely on the political side of reality. While I will not say that I am turning bullish on gold, I do think that the perpetuation of these catalysts will probably justify prices remaining elevated where they are today. That's why, even though prices have skyrocketed, I believe that a neutral stance is appropriate. A dream come true for gold and silver bulls. The way I view it, the last several months have been a dream come true for those who are bullish about gold and silver. But I think a good place to start here would be to quantify the exact journey that gold has been on. Even after prices plunged on January 30th, they are still well above what they have been in the past. As of this writing, gold stands at $4,874.20 per ounce, and silver is at $83.57 per ounce. Prior to the drop in prices that we saw, we were looking at levels of $5,318.40 and $113.93 per ounce, respectively. In the table above, you can see gold prices and silver prices from 1 year ago, 3 years ago, 5 years ago, 15 years ago, and 25 years ago. Obviously, price history goes back much further than this, but most of the activity that we have seen has occurred during these windows of time. What I find to be particularly striking is that up until the last year, prices were rising, but not at levels that I would consider to be astronomical. The chart below shows annualized returns for both precious metals compared to the S&P 500 for these windows of time. For instance, over the last 25 years, gold prices have risen by 12.3% annually. Silver has risen 12.4%. The S&P 500, meanwhile, has risen 715.1%, or 8.8% annually. This is already a big return disparity compared to what we would have seen looking at the last 100 years or so. The window of time between 25 years ago and 15 years ago saw some significant structural changes in the economy. We had the housing collapse that began in 2008. Prior to that point, we had low interest rates that fueled the housing boom. The overall supply money did increase here, and government stimulus aimed at combating the housing collapse contributed to this. Quantitative easing also facilitated asset inflation. But when we start looking at the window of time between 15 years ago and today, we see something different. Over the last 15 years, gold and silver prices have risen by 8.9% and 7.5% respectively on an annual basis. Compared to the 14% annual increase that the market experienced, that's not absurd, even if it did exceed inflation by a meaningful amount. Over the last 5 years, things have really taken off. Gold is up 21.2% annually, while silver is up 25.3%. The market, meanwhile, is up only 15.1%. Over the last 3 years, and especially over the last year, the disparity here has gotten absurd, and it points to something fundamentally broken in the economic system or to some rampant speculation that might be unfounded. To me, the answer seems to lie in a little bit of this and a little bit of that. I don't think anybody would disagree after seeing prices plummet on January 30th that there is some rampant speculation in the gold and silver markets. However, there are clear catalysts that have magnified the return disparity between these precious metals and markets. The most obvious thing that people will point to is the fact that the US government has put out a lot of stimulus over the last several years. My goal here is not to get political, it's just to lay out the facts. And the fact of the matter is that both of the last presidential administrations signed off on significant spending in response to the pandemic. Donald Trump, for instance, signed the CARES Act in March of 2020, allocating $2.2 trillion toward pandemic relief. This was followed up by another $900 billion earmarked in 2021 under the Consolidated Appropriations Act. In total, we are looking at about $3.1 trillion in relief funds. In 2021, Joe Biden signed the American Rescue Plan Act, which allocated $1.9 trillion in stimulus. Add on top of this traditional spending initiatives that both administrations put forth that had nothing to do with the pandemic, and it's not surprising that gold and silver market participants, who are individuals who fear currency debasement, would gravitate even more toward these precious metals. Spending decisions very likely have contributed to some of the recent increase in prices that we have experienced. Last year, for instance, Donald Trump signed the One Big Beautiful Bill, which is expected to add $5.5 trillion to the deficit over the next decade, while acting as perhaps the largest transfer of wealth from the poor and middle class to the wealthy that any spending bill signed has ever achieved. But one thing I will say is that I do view the narrative that government spending alone is the primary driver of the recent increase in gold and silver prices as suspect. This is because, as the chart above illustrates, after seeing a spike in the debt-to-GDP ratio because of initial government spending, we have actually seen a decline in said ratio. In the final quarter of 2019, debt stood at 105.8% of GDP. At its peak during the pandemic, it had skyrocketed to 132.7%. Some of this can be attributed to the fact that we saw economic contraction during that time. And as the global economy reopened and a return to growth occurred, we saw a drop in this ratio down to 121% as of the third quarter of 2025. To be clear, this is still elevated compared to what it was in 2022 and 2023. And it is something that we as a nation should be focused on bringing down to more moderate levels. But you would think that if the debt situation was the sole driver of this surge in pricing for precious metals, you would see it reflected in the debt-to-GDP ratio rising. Because of planned deficit spending under the leadership of Donald Trump, there is probably some forward-looking aspect to this. In March of last year, the Congressional Budget Office released its long-term budget outlook. To be clear, the measure of debt relative to GDP is different from the measure that I am including. I am looking at total debt, which includes intragovernmental debt. They look at only what is held by the public. According to their estimates using their own measure of debt, the debt-to-GDP ratio is around 100% now. But based on projected results, not only from a spending standpoint, but also from an economic growth standpoint. It could rise to as high as 156% by 2055. Certainly, gold and silver markets are reacting some to that possibility. But it's also important to be mindful of the fact that economic projections are often wrong. So there is uncertainty in this forecast. The more recent gains, I believe, can be chalked up to a couple of factors. First and foremost, the trade war situation is outright hostile to American economic well-being. There has been and remains a significant risk of stagflation caused by tariffs. They push prices up while ultimately reducing economic activity here at home. This means that the state of the economy will become more fragile if it persists. It means that monetary tightening policies are less effective. And it increases the probability that the federal government will engage in certain fiscal or monetary accommodation initiatives later on. What you have here is essentially inflation risks, combined with stress related to growth, combined with involuntary policy constraints. This naturally would cause an outflow of support from the US dollar and US assets and toward other safe haven assets. Gold and silver, for the most part, are not subject to the same political decisions that the dollar is. The US dollar index has plummeted over the last year. This is evidence that my thesis is correct. In fact, over the last 12 months, the US dollar is down 10.6% compared to a basket of other currencies. In the 4 charts below, you can also see quarterly gold consumption patterns based on category. Technology has been pretty consistent when it comes to gold. Jewelry fabrication consumption of gold is actually dropping quite a bit, though the last couple of quarters have seen a bit of an uptick. This actually makes a lot of sense when you consider that jewelry is not typically purchased for investment purposes so much as it is for adornment. So as prices rise, you would expect an overall reduction in demand for it when it comes to jewelry. More telling would be data for gold regarding allocations being made by central banks and other institutions, as well as allocations involving investments. Surprisingly, central banks and other institutions have seen purchases of gold remain pretty flat. But on the investment side, we have seen a skyrocketing amount of consumption. In the final quarter of 2025, the purchase of gold for investment purposes was 73.3% above what it was a year earlier. In fact, you would have to go back to the pandemic years to find levels comparable to this. This highlights the idea that gold prices are rising purely because market participants are flocking to it as a safe haven. Actual end market demand for it, as measured by things like jewelry fabrication and technology, is down on a net basis. And a lot of that is likely because those who purchase jewelry are being priced out of it. This helps to explain why prices have become much more volatile. And when you have an asset that does not derive its market price from utility, so much as it does from concerns over the state of the economy, speculation can become significant. Some of this speculation can be chalked up to a couple of other catalysts as well. First and foremost, U.S. diplomacy looks a lot different now than it has in the past. There has been the threat in the last several weeks of the U.S. government invading Greenland in a way that closely mirrors, in terms of justification, Russia invading Ukraine. This is not the first time that Donald Trump has advocated for the U.S. to either buy or take by force our NATO ally. But after the attack on Venezuela and the abduction of Nicolas Maduro and his wife, it's likely that the international community is taking rhetoric regarding seizing Greenland more seriously. The rhetoric, up until several days ago, had been ratcheted up by the U.S., as detailed in a letter by Donald Trump to Norway, which seems to point to a more retaliatory reason for wanting to take over Greenland. Of course, there are other factors at play as well, but when you see content like that coming out from the White House, it's understandable that market participants would get jittery at best. In recent days, the temperature when it comes to this topic has come down considerably. On January 21st, at the World Economic Forum in Davos, Switzerland, Donald Trump declared that he will not use force to take control of Greenland and will not impose tariffs that he had previously promised in the event that NATO does not allow the U.S. to take ownership of the country. Perhaps an even larger reason for the softening in the gold and silver markets comes from news regarding the Federal Reserve. In May of this year, Federal Reserve Chairman Jerome Powell will see his tenure as head of the central bank come to a close. Donald Trump announced on January 30th that he is nominating former Federal Reserve Governor Kevin Warsh to serve as the next head of the central bank. Warsh is viewed by market participants as a more pragmatic pick, who is less likely to be an ideologue than other candidates that were under consideration. Personally, I don't believe that it matters who is the head of the Federal Reserve. The voting structure of the FOMC is heavily politically insulated, and even replacing its chairman with some hypothetical ideologue would not in and of itself materially threaten the independence of the central bank. It would take something much more structural to do that. Regardless of my opinion on the matter, however, market participants clearly viewed this in a favorable light. An independent Federal Reserve is necessary to the economic stability of the U.S. If any president, regardless of which side of the political aisle they are on, can heavily influence the actions of the central bank, that is a recipe for economic disaster, because short-termism will override rational long-term decisions. Still, any sort of softening on that front helps to reduce the overall risk profile of the U.S. in the eyes of market participants. Takeaway. Moving forward, it is my belief that while the current economic and political climate remains similar to what it is now, gold prices will remain elevated. Any sort of return to a more hostile stance when it comes to other countries, especially NATO allies, and especially when it comes to political or trade issues, will serve as catalysts to push prices higher. However, absent a major escalation on that front, it's unlikely that we will regain prior highs as market participants become less worried about central bank independence. But of course, any change on that front could also serve as a catalyst. The way I view it, gold and silver at current prices might make sense for those who are worried about politically driven economic stability for the nation. You should serve, essentially, as a hedge against the future. But if you believe that the U.S. will weather this period of significant uncertainty, then banking on higher prices is probably not wise, and that is because gold is no longer pricing inflation. It is pricing governance risk, and governance risk will change as political regimes come and go. This article was written by Dan.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.